In today's video, we will be covering growth stocks, which are backed by some of the smartest investors on the planet. These are positioned to dominate over the next 5 years and beyond. I'm talking about names that super investors like Bill Ackman, Terry Smith, Chuck Akre, and many more are buying with conviction. We will be breaking down high-quality companies these super investors are buying right now with strong fundamentals, real growth paths, and also long-term tailwinds. So let's get right into it, starting with a massive conviction play from Bill Ackman. This conviction play is Uber. Uber is no longer just a ride-sharing app, it's becoming a dominant infrastructural layer for urban mobility, delivery, payments. The list goes on and on really. They're also doing freights such as global order and delivery. And one thing which cannot be understated with Uber is that they are finally profitable. They're making a ton of cash in free cash flow and it's showing in the numbers. And I think Bill Ackman spotted this a little bit earlier than the market. So he made a play and it's now up big already because Uber stock went on a run recently. So in Q1 of 2025, Ackman increased his stake in Uber to nearly 19% of Pershing Square's portfolio. It's now one of his largest bets in that portfolio. So what's the play here? Uber's scale is finally translating into profits, and over the years they have tried to cut costs and become more operationally efficient with things like automated routing. They expanded into subscription services such as Uber One, where you can sign up and get certain benefits. If you use Uber a lot, it's worth it, but it is a subscription instead of just a one-time ride, for example, or a one-time delivery. So I think Uber is really showing their moat here, their branding power as well, because Uber does have a very strong brand in my opinion. And if we look at other products such as Uber Eats, it's also showing that it's quietly becoming a cash machine. They have record-breaking numbers in North America and also big growth in international markets. And if we look at some of the financial and operational highlights for the first quarter of 2025, we can see a highlight, which is that trips during the quarter grew 18% year over year to 3 billion, driven by monthly active platform consumers. So that's the total amount of consumers which are on the app, which is also showing growth of 14% year over year, while the monthly trips per that same monthly active platform consumers amount grew by 3% year over year. And I believe the big picture play of Uber is kind of mimicking the super apps that we see in China and also Southeast Asia, where we have, for example, WeChat or Grab, which is essentially an app where you can do everything. You can book rides, you can book food delivery, you can book grocery delivery, and now even do stuff such as car rentals, booking a plane on your app. Of course, that's for the rich, but it's still a sign of what they want to do with the app, right? They want to create a super app where you have one app and you can basically do everything that you need to book for a certain day in that app. And the gross bookings showed double-digit growth year over year as well, reaching 42.8 billion last quarter. If we look at the total revenue combined with the 4 PE graph, we can see a trend where we see the total revenue increasing quite rapidly and actually accelerating in growth, while the 4 PE is decreasing. Now it's curling up a little bit again because the stock price ran up, but I still think the valuation is attractive here. And if we see a slight dip, I might step in depending on how the traction with robotaxis goes for the other brands such as Waymo, Tesla, etc. I think that's the biggest risk with Uber right now, but I still think even with that happening, that there is no single winner there. And Uber has such a broad network and service and brand name that I think that they will always have a big piece of the pie. So I am bullish on Uber, and if we see a dip, I will be stepping in. Next up, we have Microsoft, who got bought by Tiger Global, which is headed by Chase Coleman. The total investment stake costed them $811 million, netting them an eventual gain so far of 282%. As we can see, the average buy price was $130. The share price right now of Microsoft is roughly $500, so that gain is absolutely massive. We have other super investors showing their bullishness on Microsoft as well, such as Terry Smith, where it's accounting for around 9% of his current portfolio, and he stayed patient through every pullback, which we can also see in Tiger Global. One big part of why Microsoft is so successful is the cloud, and specifically Azure. If we look at the market share of Azure right now, it's about 21% in Q4 2024. Now, Microsoft did report last quarter that their market share grew again, and their total revenue from cloud is also still growing. So it's still continuing to gain cloud market share, while also growing faster than its competitors, such as Google Cloud or AWS. The biggest strength of Microsoft, in my opinion, has always been the focus on sticky subscription models, such as Office, we know Windows, of course, even Teams, Discord, that kind of stuff. And their big focus on that means heavy recurring revenue that's sticky within enterprises, but also in the consumer segments. We can also see that their investment in OpenAI is working out perfectly, where they now have a 49% ownership stake and also rights to up to 75% of all profits until the time it receives back its investment. So OpenAI is obviously growing super fast, and Microsoft also owns the IP rights to OpenAI in their products such as Copilot. I think it's another testament to how Microsoft operates in the market generally. Their focus on sticky, high margin subscription services that increase user engagement and also retention across their other products. Microsoft is very good at capital allocation and getting a good return on that capital. Another good example of that is their acquisition of Activision Blizzard, which happened a few years ago. With that, they are now unlocking new monetization angles in gaming and also things that might happen in the future, such as the metaverse. So Microsoft is really everywhere. The financials of Microsoft also look really strong. So last year, total revenue ended up at $245 billion, which is up 16% year over year, and it's showing a compounded annual growth rate over a longer period of time of 10.45%. The projections right now is that Microsoft will hit $270 billion in revenue in 2025, and so far it looks like they will be hitting that. The most bullish trend right now for Microsoft, and why investors are also super bullish on the stock, is that the cloud services are showing significant growth, which is also accelerating year over year, with total revenue last year ending up at $137 billion, while the projected revenue for 2025 is $159 billion. Free cash flow is also super strong. Microsoft honestly has always been strong in this regard, but last year they hit an all-time high of $74 billion in free cash flow that has been generated. The gross margin of Microsoft is now dipping a little bit below 70%, where it was higher historically speaking, but it's still very high for the scale that it's operating at. And the most bullish thing about this is that the operating margin is reaching all-time highs right now, with last quarter reporting 45%. If we look at 4PE as the valuation metric, we can currently see that it's trading around 34 right now. If we look at the total revenue increase over the years and the 4PE ratio right now, you could say that it's trending around all-time highs, which is true. But I do think that the valuation is still attractive because the revenue is just accelerating in growth and is much higher than previous years, where it had kind of the same valuation, but the revenue and profit was much lower. So all in all, I'm really bullish on Microsoft. I love what they are doing. I love their products. I use them daily as well, which is big for me as an investor. I look at products or services that I use myself or would use myself if they are available to me. And in that sense, I think Microsoft fits that criteria. They have really sticky revenue, they have acceleration in growth across multiple segments, and their valuation is still attractive for me. So I already have a position in Microsoft. I do want to increase it. As soon as I see a dip, I will buy more. Intuit is up next, and I think it's flying under the radar for most investors. It's pretty popular in fintech, but right now, smart money is also quietly loading up. We do see Terry Smith just added to his position in Q1 of 2025, and it's now one of his highest growth bets in the portfolio. One big reason to be bullish on Intuit is that they own a lot of technology under their platform. So they have a lot of products such as TurboTax, Credit Karma, QuickBooks, MailChimp. They also now have their own AI operating system, which is called GenOS, and they are moving into the agentic AI space. So they mentioned that they are building for approximately 100 million consumer and small and mid-market business customers, not only to keep pace with rapid technology industry advancements, but also setting the pace by melding the best of artificial intelligence and human intelligence on its platform. For example, agentic AI built with GenOS is doing the hard work on behalf of business owners. And I am really bullish on agentic AI software because I really see in maybe 1 or 2 years from now, most people using some sort of an AI agent for their work or for their personal use to just automate more stuff that you are doing anyways, but it can be automated to some extent. So think about like boring stuff, for example, bookkeeping or doing research on a specific topic. You won't need to do that anymore. You just write in a prompt that we see right now with ChatGPT, but then you get like an agent that is specialized in a certain field or thing that you need. They are also continuously launching new products such as QuickBooks Ledger, which expands into mid-market and enterprise accounting, taking on competitors such as Oracle and also SAP. I think the result of all that Intuit is doing is that it's creating a sticky ecosystem of small businesses who rely on Intuit's software to run everything on the day-to-day. So with that, I think you get kind of a comparison to Microsoft in my opinion, because Microsoft is more focused on the enterprises, but it's the same concept. Whereas Intuit is focused on mid-market and small businesses. So they want to offer everything that this business needs to keep the business running in a day-to-day, but they do it in a fashion where it's sticky and they cannot really leave anymore. If we look at the total revenue graph for Intuit, we can also see another reason to be bullish on the company, because total revenue is absolutely exploding and accelerating the last few years since 2020, give or take. Last year, total revenue for Intuit was $16.2 billion. And this year in 2025, it's estimated to end around $18.2 billion. And one of the more remarkable things to me about Intuit is their ability to operate super lean and efficiently while making free cash flow like a machine, right? Because last year they came up with free cash flow numbers of $4.6 billion. And this year, it's estimated to end around $6.1 billion in free cash flow. This is just a testament to how efficient this software model is. They are lean, they are scaling, and they can show that they don't need to scale, for example, their headcount or something to make revenue explode. They simply try to offer more services and scale the existing ones to grow the business overall. If we combine the 4 PE ratio with the total revenue growth for Intuit over the last few years, and also last year and this year specifically, we can see that it's currently trading at around a 4 PE of 34. And if we take into account the explosive revenue growth that it had and the PE ratios it had in the past, I think it's now undervalued and it is a buy today. And as I'm getting more interested in good fintech plays, because I made a play on Robinhood earlier this year, which panned out great, I'm still in that position and it's up by more than 50%. I am looking for new positions to open in this space, so I will cover this in a future video as well, but Intuit is definitely a candidate. So that's it for today's video, everybody. We covered 3 growth stocks which super investors are buying right now, and I think they are still a buy at today's prices. If you see a dip in these stocks, it's a very strong buy signal in my opinion. So if you have space in your portfolio and you're looking to open a new position, you could look at these stocks to pick one and see if you can get a good entry price. Otherwise, it's also good to just step in right now because I think they will outperform the market over the next 5 years. They are all profitable. They're also backed by some of the smartest capital, which is active in this game. Super investors are buying and holding them for a reason. They see long-term compounding potential and also the business models that thrive through cycles. It doesn't matter if it's like a bull market or a recession, they will always have a good business result. If you like this type of content, please leave a like, comment, and subscribe to the channel. I want to thank you all for the support in the first month. We already hit 350 subscribers, so we are well on our way to 500 and 1,000 subscribers in total for the channel. Again, thanks for the support, and I will see you guys in the next one.